Our next guest raising his S&P target by 500 points up to 5,300 with a bull case of 6,000 if big tech cooperates. Barclays head of U.S. strategy, Venu Krishna, joins us now. Why now, after the already pretty strong run-up we've had in the market thus far?
So two principal drivers for that. First is recognition of the exceptionalism of the strength of the U.S. economy, especially when you compare it to developed markets in Europe or, for example, China. And that is being driven by strength in consumption, especially services, but also goods, improvement in sentiment, PMIs, manufacturing PMIs turning, new orders improving. So the whole base is improving. And then this virtuous cycle between a strong labor market, wages, and consumption. So that's one. The second exceptionalism which we recognize is that of big tech. So we've been fans of big tech since 2022, even when it was selling off. And our view is that that continues to get strengthened. And so the entire earnings growth in S&P is pretty much being dragged up by big tech, and we don't see that reversing anytime in the near future. So when you put those together, there's no other alternative for us but to increase the price target. But I'll tell you that our base case is still about 4% higher than where we are. So that will be a deceleration from last year, but still a pretty healthy return in the big scheme of things.
So what happened differently than you originally forecast in the fundamentals? It just that the economy was on stronger footing? Because going into the year, everyone was saying we're not going to have a recession. We got a big surprise on that front in 2023, and the fundamentals look good.
Yeah, so I think what's changed, like I said, is one, the economic backdrop has improved quite markedly, right? And so that is beginning to show up in numbers. And two, the tech numbers are going from strength to strength. So if you look at Q4, big tech earnings are up over 60%. Over that same period, the S&P outside of big tech, the earnings are actually down about 2.5%. It's the same situation with revisions. Big tech revisions are up over 6% since November, and for the rest of S&P outside of tech, it's down 3.5%. So the bifurcation has actually continued to widen. And at the same time, the macro overall parameters have improved markedly. So in other words, the balance of the risk reward is now tilted to the upside, with the potential for reacceleration in growth actually outweighing the potential for recession to kick in. So the odds have just changed. So if we thought the risk of recession was 15% earlier, so now I would say it's 5 to 10%. And in fact, the bulk of the upside comes from either reacceleration or strengthening core demand in itself, which is our base case.
All right, so it's all about tech still, basically, is what you're saying.
Absolutely. It is all about tech, and that's why I would say that one of the things we continue to believe in, that we have to learn to live with the narrowness in the market, the narrowness in returns and the narrowness in earnings, which is big tech-centric, and it is unlikely to broaden which is different than the broader hope that it does broaden, because we do see margin pressures still out there for most of the sectors outside of, let's say, discretionary right now. And that is unlikely to change because the significant progress we've made on inflation actually turns out to be negative for nominal earnings because it is impacting margins negatively. And that is unlikely to change. The difference is tech stands out, and you see that in numbers over and over again.
We were talking to Julian Emanuel last hour of ISI, Evercore, and he sees all sorts of signs of frothy behavior and FOMO behavior in the market. He cited the short interest levels extremely down and thinks that that's a good reason that we actually might see this rally pause or a potential downturn from here. Do you not worry about those kind of signals after such a strong run-up?
We do. In fact, we have said that. So one of the things we have sort of discussed in our work is that the narrowness in the market historically itself becomes a trigger for some consolidation, and often it's led by the leaders. What's different right now is that even if you look at big tech, after COVID, they were trading at 37 times forward earnings. Right now, they're trading at 28 times. But it did dip down to 25 times. The difference in our call now, we are saying, is that when this corrects, it's likely it could happen because as the narrowness gets even more narrower, there's a lot of sort of angst in the market. But this time it will be buyers because the longer-term trend, if you look at 3 to 5 years, is undoubtedly in favor of tech, especially big tech. as the foundational sort of players in the components and the hyperscaler area, which is going to benefit from this whole AI adoption cycle.
Got it. So the difference there is that you're strong.